Good afternoon. I'm Jill Malandruno, Global Markets Reporter at Nasdaq. And for this edition of Trade Talks, we're going to look at acquisitions in the real estate space. We cover everything here. If you can invest in it, we're covering it at Nasdaq. Joining me is Scott Mehlman. He's the Vice President of Acquisitions at Colony Hills Capital. Thank you very much for joining us all the way from Boston.
Thanks for having me. It's a pleasure to be here.
So we're going to talk about multifamily managers today, and we want to know how your approach is different when it comes to this investment.
Yeah, sure. We have a completely unique acquisitions approach. And from that end, we have spent the last many decades, collectively as a team, putting together a proprietary network of owners, small shop real estate brokers, and a wide range of third-party service providers who are constantly feeding us multifamily investment opportunities. So they do that because we first and foremost consider ourselves buyers of cash flow. Secondly, we're buyers of real estate. So we get all these deals coming from us, and it means that we have a much broader investment spectrum that we can invest in. So we get a deal, and then we work bottom up. We try to build a business plan around that deal. We say, okay, we underwrite it financially. We think these are the returns we can hit. How do we craft a viable, executable business plan to get us from where the property is today to where it should be to hit our objectives? And what this process does, it allows us to do a tremendous amount of off-market transactions. Since our inception, we've structured and closed 25 different multifamily properties. Only one of those was mass marketed. And we like to think of it as we prefer to negotiate the best price rather than submit the highest offer.
Right, so you actually look for the deal specifically. You won't have target markets in mind.
Exactly. We try to stay broad because just because maybe a market, as far as the media or the broader, public is concerned is doing poorly, it doesn't mean there aren't pockets and assets that you can have great success with.
So what do you look for when acquiring a property, and what do you think should be avoided?
Sure. So first and foremost, we look for poor in-place management. That's the low-hanging fruit in our business. That's stuff you can fix quickly and inexpensively. You can get your rents up to market, which is where they should have been. You can operate the property more efficiently to reduce your expenses. And just by marketing the property better, you improve the value of the property really quickly and with spending very little money. The next thing we most importantly look for is a property that either has deferred maintenance or a lack of updates and upgrades in a thriving market, because that thriving market helps to prove out your business plan. It says, if you do this to your property, you should get this in rent. Things to avoid are your typical overbuilt, oversupply markets. It's worth doing your homework in advance. Do your homework, meet with the building department, find out how many permits have been pulled, look at future job projections. Can they absorb all that new inventory so it's not going to negatively impact your property? And secondly, you really want to focus on a market that has a diversified economy. If they're heavily reliant on one industry, you're exposing yourself to market risk in that industry as well.
I was just going to say, it's more than just understanding the real estate business. You have to wear your economic hat as well.
Significantly.
Right. So give us some examples of Colony Hills Capital in action.
Best example is what we've been able to do in South Atlanta, Clayton County. It's a historically troubled market. And one of our brokers in our network of off-market providers called us up and they said, hey, I've got a property. It's only 2 miles away from a property you already own, but it's got a troubled past. Would you be interested? And we love troubled pasts because that usually means there's stuff we can do with it. So this property had been foreclosed on by Fannie Mae, subsequently sold to a local nonprofit housing authority to provide families affordable housing because they were all 3 bedrooms. And they were renting those 3-bedroom units for $690, including water. We, 2 miles away, were renting 3 bedrooms for over $1,000, not including water, for the same vintage property. So we bought it as quickly as we could, unrolled a $1.5 million renovation program, which totally renovated the exterior with the new paint scheme, all new amenities packages, and renovated 100% of the unit interiors with cabinets, counters, appliances, new flooring, plumbing fixtures, and lighting fixtures. Those same $690 units are now renting for $925, and we're adding water on top of that. We very recently received an offer to acquire the property unsolicited that we just had to take, and if everything goes to plan, we're going to have an exact 2-year exit, and our investors will net a 50 IRR and a 2.5x multiple. So we're very proud.
It's one of those cases where you have to spend money to make money, for sure.
You got to spend money to make money, and we've got a full pipeline ready to go on the next one.
All right. Well, thank you very much, Scott, for joining us
at
the Market Site, and thank you as always for joining me. I'm Jill Malandruno, Global Markets Reporter at Nasdaq.